Welcome to the City Current Show. I'm your host, Jeremy Park. We're always honored to bring you inspiring stories of individuals and organizations making a difference and powering the good. And we love having our City Current partners come on and share a wealth of information. We're going to talk about your wealth and protecting it, growing it, and so much more. Here with us, we have Chronicle Partners. We have Brian Reichenbach. He is the COO and Co-Founder, and Chris White, the CEO and Co-Founder. How are you two guys doing?
Doing awesome. Well, thanks, Jeremy.
Thanks for having us.
So Chris, Brian, let's start out with a little bit of just how you describe the work you do, because I mentioned wealth management, protecting, growing assets, but it's so much more. So when you talk about a little bit of a description, give us some description on Chronicle Partners.
Thanks, Jeremy. It's always a joy to be with you, man. I always get pumped up when you do those intros. And I saw what you did there with a wealth of knowledge. That was very, very well done, sir. Yeah, Chronicle Partners, we specialize and focus on comprehensive financial planning. And I think what all those words I just used are buzzwords, and different people interpret them in different ways. And in fact, I was visiting with a gal this morning, and different, folks hold themselves out as financial advisors, financial planners, wealth advisors, and really different people that carry those titles do a lot of different things. And so for us as financial planners, Brian and I are certified financial planners. We really specialize in that comprehensive plan, which is really eight pieces. So you've got retirement and investments, which that's what most people think of when they think of financial planners or financial advisors. But then we also really dig into tax planning, estate planning, charitable planning, insurance. You got some people that just focus on insurance, and then cash flow management, as well as education planning. So those are the 8 pieces. And what we do as a team, and we work very collaboratively as a team and with other professionals to bring in those services. But what we do is we look at each piece individually of the plan. We make sure that each piece is in good shape, that, we figure out where are we today, where do we desire to be? And then we make tweaks and changes in each one of those pieces, and then we pull it all back together, develop the plan, implement the plan, and then monitor moving forward with a high-touch client service model. So we do the comprehensive planning, we care for assets as well, and then we also do some business strategy with some of our business owner clients as well. So big picture, that's what we do.
Yeah, and I love the fact that you kind of point out all the different pieces of the puzzle, and that so many focus on one or two, but there's a lot that goes into it. And as you mentioned, it's not just the collaboration with your team, it's the collaboration with other experts. Brian, dive into that a little bit on when you're pulling all these different pieces of the puzzle together and all these different collaborators. What does that look like? How does that manifest itself on your end?
That's a great question. I think anytime someone asks me what we do, I always bristle because it's so hard to describe, and it's so hard for us to explain exactly how we might bring value to each individual person. So this is one really good way that honestly almost no one, especially the more complicated your situation gets, very few people can really explain how all of those different pieces work together. And honestly, a lot of people assume that they do just kind of function the way that they should. And unfortunately they don't. And I think a tax return is a good example of a lot of folks think that their CPA knows everything and that everything's going to be entered in the way that it should. But if you've got a financial planner and you've got a CPA, those two people should be talking. I mean, they really need to be, because the tax form that you'll get from your investment account doesn't tell the whole story. You've a lot of different examples that you can use, but unless there's a conversation and to dive beneath that surface level of detail, some pretty big things can happen. So, Chris mentioned estate planning too. Again, that's another great example of, you can do some really, really great planning, but if you don't dot the I's and cross the T's, you can miss out. I mean, as basic things of, we create a trust and then we don't adequately title or correctly title things to the trust, the documents are pretty much meaningless now. So you can have the best intentions, but unless you've got some folks helping explain why you're doing the things and how the different puzzle pieces fit together, a lot of the best laid plans just don't get you where you want to go.
And that goes back to the education component. But like you said, it's more work to reach out to the CPA and make sure that everything is, correct and planning ahead and looking at all the different scenarios. But the end result is so much more powerful. And what it means, obviously, to the client is, that's the whole difference. One of the big things, obviously, is the stock markets right now, inflation. There's a lot of things going on. How do you contextualize that for your clients? Let's start there, and then we'll kind of take them as pieces. But how do you contextualize what's going on right now and put it in kind of a frame of reference for your clients?
It's a good question. I think the big headlines right now, like you said, inflation is the big one that's caught a lot of headlines. We're at, I think the most recent number is 7.5% inflation rate, the highest since, I forget the year, but the 80s, 1982, something like that. The highest rate of inflation for 40 years, which is pretty wild to think of. So inflation, and that's been a huge change, because we have been in an extremely low inflationary environment for a long time. So this has been something that we've known has been coming for a while, but it has been it's been a torrent. It's been a monsoon as opposed to a trickle in that direction. It really hit us in the face. So that along with the fact that the stock market has been doing really, really positively up until the last month. We had a major decline with the outbreak of COVID at the beginning of 2020, and then really since then, through a lot of negative news headlines, the stock market's been very, very positive, to the surprise of many of us. So the last big headline, I think, is interest rates. So interest rates have been very, very low for a while. They are starting to rise, and the Fed has intimated very, very clearly that they are going to start raising interest rates probably 2, 3, 4 times throughout the course of this year. That's again something that we've known has been on the forecast for a long time, but we're now there. So interest rates rising plus inflation has caused the most recent decline in the stock market we've seen. We've seen the correction that we've been waiting for the last couple of years. It's normal. I think that's the most important thing to talk about. It's normal. The good statistic that we always talk about is every calendar year, so a correction is defined as a 10 to 15% decline in the stock market. And every single calendar year, not every single, but the average decline in every calendar year is just over 14%. It's normal to have a correction every single year. It's always a different reason. We always look in the rear view and say, why did it happen? But it's normal. It always happens. And that should not derail. It shouldn't change your planning, part of your planning. And, you talk about contextualization. When you're investing, you're looking at your goals and your time frames around the dollars that you're investing. You got to be prepared for these declines, because if you're investing for retirement, you've got decades to go. So buckle up, because you're gonna see a lot of declines like this, and it's part of the ride. And you need to be prepared for it. And if you're someone who just can't handle quite as much volatility, then there are ways to invest more conservatively. But the downside right now for those folks that are more conservative is that rising interest rate environment. In the low interest rate environment, conservative investing is very, very challenging right now. So it's a really challenging environment for folks that are entering retirement or close to it.
One of the things that we've talked about in the past is the fact that sometimes you lose sight, or you don't quite understand, like you see the dollars go down, but it's not, when you're investing in, it's not necessarily the dollars, it's the ownership of the percentage. So in other words, it's a percentage going down. You still own the stocks. It's just a matter of the valuation. The valuation can shift up and down. And so not necessarily, to your point, looking at getting stuck in the day-to-day, dollars up, dollars down. It's looking long-term and realizing, okay, I've got this sort of ownership stake. Over time, it's going to continue to grow and get me where I need to go. And so once again, back to context, it's important to understand and not get caught up sometimes in the small day-to-day versus the long-term goal, as you're talking about.
That's exactly right. Yeah, especially for the long-term planning, we're not we're not planning, I don't want to say you shouldn't care because that's a little harsh, but you don't want to focus on your value tomorrow or today. You want to focus on your value and your purchasing for years from now. Because again, inflation, and this is the right time to talk about it, because many of us hadn't really had to worry or think about inflation. But that gallon of gas, the loaf of bread, is a whole lot more expensive today than it was a couple of years ago, and that's going to become even more stark 2-3 decades from now.
Yeah. Chris, what would you add in terms of not just the context as Brian is alluding to and understanding kind of the big picture, but also too, what that means for you on the education front to really be proactive with your clients?
Yeah, it's a great question. We had a conversation with the client, goodness, probably 3-4 weeks ago. And I love that Brian reiterated that this time is not different. And I think it was Sir John Templeton that said it. If not, it was someone, in bygone years. But when folks say that this time is different, it's not. It could look different, but at the same point in time, what we've seen, at least through history, would suggest that where we are today is not, from a planning perspective, it's not going to shift the way that we should plan. And so I think the thing that I continue to be reminded of, especially when you're looking at headlines, especially when you see the market correct like it did earlier this year, albeit that was a short correction, it went like this and then popped back up really quickly. But I'm just reminded of the importance of planning. And we continue to bring those that we get to serve, we continue to bring them back to that of, again, we have to trust in the process. We've got to trust in the plan that we're putting together. And when the market goes down, again, as Brian said, that's normal. It's actually healthy. There's good health to the market correcting, and then that also presents opportunities. There's some silver linings. And so and with rising interest rates, one of the interesting things that in a conversation that we've been having with folks is the old adage that you want to have as much in bonds as your age. That's something that's been an adage for the last 30 or 40 years, meaning that the older we get, the more that we want to have fixed income in bonds. And for some people, that's still probably applicable. But for a lot of folks, because of the relationship between rising interest rates and bond values, when interest rates rise, generally bond values decline depending on the bond. That might not actually be the right adage. That might not be the right recipe moving forward. So what we always want to do is we want to make sure we come back to the plan, set proper expectations, educate, and really help folks focus on the long-term goals and desires, and make strategic tweaks and changes every once in a while, maybe tactical, but just bring them back to the importance of that plan.
For each one of you, you talk about silver linings. Give me something that excites you as an opportunity. And this can be you. I mean, we've talked, you and I have talked many times about just the philanthropic giving and how creative. There are some huge opportunities that people don't take advantage of and don't realize that they can really leverage to be more impactful with nonprofits. You've got obviously the silver lining as we're talking about with what's going on right now. So you got a lot of leeway with this question, but what's something that excites you about where we are right now in this moment, looking forward?
I'll start with the silver linings of a down market and just give you a few different things that are good to think about doing. Silver linings is a good way to say it. I say, again, it's kind of making lemonade with maybe the situation that no one really enjoys. So the first one is just really very simple of just, and really most of these are just takes on this first idea of buy low. You've got time. If you have money that you're not going to use, it's a good time to get new dollars invested. Exactly to what you were saying earlier, Jeremy, from a valuation standpoint, we're buying 90 cents on the dollar. So we're getting more bang for our buck with the new dollar that's going in. So a new contribution, looking at your investment allocations. If you're invested more conservatively today than you need to be, it's a good time to turn the aggression level up potentially. You're tying it to the account and your goals and what you're comfortable with. But if you're in a conservative allocation today and you've got 10 or 20 years before you're going to use the money, it's relook at that and say, a fixed income and move it over to the stock side. Similar to that, just rebalancing accounts. It's a good time to rebalance accounts, and that's just just kind of a little bit of a twist on that, of just shifting some bond money potentially to the stocks while they're down. From a tax standpoint, it's a really good time to look at conversions. So the idea there is, if you've got pre-tax retirement accounts, you're going to pay income taxes on those dollars at some point, outside of charitable giving, actually, which we can come back to. So, but you're going to pay taxes on pre-tax IRAs at some point. And again, the idea of 90 cents on the dollar, if you've got $100,000 in an account, it goes down to 90,000. At 90,000, you pay taxes on 90,000 instead of 100 in the future, more. So, by getting money converted from pre-tax to after-tax, meaning Roth, you can lock in the value at a lower amount while the market's down. And then when the market rebounds, that appreciation is tax-free inside of a Roth. So that's one thing that it's a good thing to look at, especially if you're planning on doing this. To Chris's point, we want to do the planning ahead of time because we want to think through the tax implications. It's not a good idea just to willy-nilly, let's just start converting things, because that's a major tax impact. But if you want to do a conversion, you want to do it. Hey, it's a good time, a push to do it. Chris, what am I missing? What would you add?
Jeremy, one of the things I always appreciate about visiting with you is you always bring us back to the philanthropic and the charitable side of things. And as Brian alluded to, there's such great opportunities. One of the things that I see opportunity-wise here moving forward is, especially in the conversation, in the context specifically the conversation that we've been having over the last year or so with potential rise in taxes. And one of the things that hurt the nonprofit industry was several years ago when they doubled the standard deduction. A lot of folks, when the standard deduction was $12,000 as a couple, their charitable giving would allow them to itemize. Well, a lot of people didn't actually get over that amount once they doubled it, and so who knows where taxes turn out in the next handful of years. We do know as of right now that a lot of this stuff sunsets at the end of 2025 and would revert back. But in some of these conversations, if they do increase capital gains tax, for instance, for some folks, if they do increase the tax brackets for ordinary income, it makes charitable giving that much more attractive. And so I think that's an opportunity that we have, especially for business owners. One of the things, I was talking to a gal earlier today, we're looking at doing a quick seminar, like a 30-minute seminar on charitable planning. And we were talking about specifically the opportunity that business owners have to actually give shares of their business. They can give it away before they sell, which could save, depending on the sales price, my goodness, it could save hundreds of thousands, if not millions of dollars in taxes, and potentially increase the impact that they have with their giving. And so there are opportunities out there. And I think as the tax conversation continues, and if we do have changes in the tax codes here moving forward, it could bode well for some of that charitable planning in an industry that was hit pretty hard in the last several years because of the increase in the standard deductions, which again, that was actually, in my humble opinion, that was helpful to a lot of people to have that standard deduction doubled. But anyway, I think there's some really sweet and good opportunity in the future for charitable planning and giving.
Yeah. Well, you all are definitely a wealth of information for sure. And I love the fact that you really dive into the specifics and give people the education side of this versus just kind of glossing over it. So I love the fact that you all go so deep and really give specific examples. Wrap up, because obviously for individuals who are looking for help, for families, business owners, I mean, just like you're talking about, Where do we go to learn more about Chronicle Partners? Website, social media, phone number? Where would you direct everyone to go and connect in with you all?
Best place to find us is at chroniclepartners.com. Very simply. And that's going to have all of our information about our team, about what we do. It's got all of our contact info on there. And so that is the best place to find us. Of course, we have the social media stuff with Twitter, Facebook, Instagram, that kind of stuff too. But I would say, come on to the website.
Well, Chris, Brian, thank you for being Citi Current Partners. Thank you for all you do. I love your philanthropic heart as well and the difference you make. Thank you for coming on the show.
Thanks, Jeremy.